What would you do if you found out someone had been stealing from you for 14 years? Not a stranger, not some hacker in a foreign country. Someone you trusted, someone you saw every week, someone who smiled at you, asked about your kids, remembered your name. What would you do if I told you they'd opened credit cards in your name without asking, created bank accounts you never knew existed, charged you fees for services you never wanted, moved your money around like it was theirs, and when you finally noticed something was wrong, they looked you in the eye and said, "Must be a mistake, we'll look into it"?
What if I told you this wasn't one person?
It was 5,300 people, all working for the same company, all doing the same thing, all pressured by managers who knew exactly what was happening and demanded it continue. And what if I told you the company they worked for wasn't some fly-by-night operation? It was Wells Fargo, America's fourth largest bank, a 167-year-old institution, the bank with the friendly stagecoach in the commercials, the one that promised together we'll go far. Here's the question that should terrify you. If they were doing it to millions of other people, how do you know they weren't doing it to you? Because here's what happened. Between 2002 and 2016, 14 years, Wells Fargo employees created 3.5 million fake accounts in customers' names. They forged signatures. They opened credit cards people never applied for. They moved money without permission. They destroyed credit scores. They charged fees on accounts customers didn't know existed. And when customers complained, Wells Fargo covered it up.
When employees refused to commit fraud, Wells Fargo fired them.
When whistleblowers called the ethics hotline, Wells Fargo retaliated. This isn't a story about Wall Street greed or complicated financial instruments. This is simpler, more personal, more terrifying. This is about the bank branch on Main Street, the one where you opened your first checking account at 16, where you know the tellers by name, where they serve free coffee and remember you like your receipts printed, not emailed.
That bank was robbing you. The teller who smiled and processed your deposit, she was opening a secret savings account in your name to hit her quota. The friendly banker who helped with your mortgage, he was enrolling you in online banking you never requested. The manager who seemed so helpful, she was coaching her team on how to forge signatures without getting caught. But here's the twist. Most of those employees didn't want to commit fraud. They were forced to choose between their conscience and their job, between ethics and their rent payment, between doing the right thing and being able to feed their kids. The ones who refused, fired. The ones who spoke up, fired. The ones who called the ethics hotline, fired and blacklisted so they couldn't work in banking again. And the executives who created this nightmare, the ones who set impossible sales quotas and looked the other way as millions of fake accounts piled up. The ones who made tens of millions of dollars while the fraud was happening.
They walked away rich.
John Stump, the CEO, retired with hundreds of millions. Carrie Tolstead, the executive who ran the division where all the fraud happened, walked away with a $125 million exit package. When prosecutors finally caught up to her years later, she got 3 years of probation, no prison time, for orchestrating a fraud that destroyed millions of lives. So here's what I need you to understand. This story isn't ancient history. It happened in your lifetime, at a bank that still operates today, with branches in your city. Maybe you're even a customer. And the people responsible? Most of them faced no criminal consequences. They paid fines that were a rounding error on their net worth. They got banned from banking and retired to their vacation homes. Meanwhile, the low-level employees who were pressured into fraud, 5,300 of them were fired, made scapegoats, blamed for following orders, destroyed financially while their bosses played golf. The victims? Teachers who lost their cars to repossession because Wells Fargo secretly added insurance they couldn't afford to their auto loans. Young couples whose credit scores tanked because of credit cards they never opened. Retirees who discovered mysterious accounts had been draining fees from their savings for years. And when the scandal finally broke in September 2016, when regulators announced Wells Fargo had defrauded millions, the bank's first response was to blame the employees they'd been forcing to commit fraud. That's the world we live in,
where a bank can rob its own customers for 14 years, fire the people who tried to stop it, enrich the executives who enabled it, and survive with barely a dent in its business.
So before we go any further, let me ask you 3 questions.
Question 1. Have you checked your credit report recently? Because if you were a Wells Fargo customer any time between 2002 and 2016, there's a real chance you have accounts you never opened, credit inquiries you never authorized, fees you never should have paid.
Question 2. If your employer told you to commit fraud or lose your job, what would you do? Would you do the right thing and risk everything? Or would you cross the line to keep the paycheck coming?
Question 3. When the people at the top commit crimes and the people at the bottom take the fall, when whistleblowers get crushed and executives get golden parachutes, when billion-dollar corporations pay fines and nobody goes to prison, when that's the pattern over and over again, what does that tell you about the system?
This is the story of Wells Fargo. How pressure became fraud. How fraud became culture. How culture became crime. How crime became unfortunate but isolated incidents. How millions got hurt and nobody powerful faced real consequences.
This is crime in cubicles, fraud in polo shirts, betrayal with a smile and a branded pen.
This is what happens when a bank decides growth matters more than ethics, when executives care more about stock prices than customers, when corporate America learns that crime does pay if you're big enough, rich enough, and shameless enough.
Buckle up, because this story will make you angry. It'll make you check your bank statements. It'll make you wonder who else is doing this right now. And it'll show you exactly why Americans don't trust their banks anymore. Let's pull back the curtain on the biggest consumer fraud in modern banking history. Let's talk about the 14-year con. Let's expose the lie behind the friendly commercials and the free coffee. Let's talk about the day America learned that when a bank starts robbing its own customers, nobody's safe. San Francisco, California, early 2000s. The message came down from corporate like gospel. 8 is great. 8 products per customer. That was the goal. The metric, the holy grail. If a customer came in with a checking account, you needed to sell them a savings account, then a credit card, then overdraft protection, then online banking, then a mortgage, then auto insurance, then investment accounts. 8 products, 8 touch points, 8 ways Wells Fargo could extract fees. They called it cross-selling. Industry analysts loved it. Wall Street rewarded it. Wells Fargo's stock price climbed as executives bragged about their cross-sell ratio, the average number of products per household.
In 2010, CEO John Stumpf told investors Wells Fargo's cross-sell ratio was 5.98 products per household. By 2013, it hit 6.17. The goal? 8. 8 is great. Stumpf repeated it constantly. It became a mantra, a measurement of success.
There was just one problem. Customers didn't want 8 products.
Most people wanted a checking account, maybe a savings account, perhaps a credit card. That's 3 products, not 8. Convincing customers they needed 5 more was difficult, impossible even for many households. But the pressure didn't care about reality. Inside Wells Fargo branches across America, managers received daily sales goals, not suggestions, mandates. You needed to open X number of checking accounts, Y credit cards, Z savings accounts, every day, every week, every month. Miss your numbers? You'd hear about it. Your regional manager would call, your district manager would visit. They'd pull you into the office and ask what the problem was. Why weren't you performing? Hit your numbers? You got bonuses, recognition, maybe a promotion. The incentive structure was simple and brutal. Sell or suffer.
Yesenia Guitron worked as a personal banker at the St. Helena branch in California's Napa Valley, starting in 2008. She was good at her job, friendly, professional. Customers liked her.
But the quotas were crushing. I kept complaining and nothing ever gets done, Gutron would later tell CBS News. I was doing what my conscience was telling me to do. It's fraud, that's what it is.
Because here's what was happening.
When you couldn't convince customers to open accounts they didn't need, you had two choices: miss your quota and face consequences, or cheat.
Thousands of Wells Fargo employees chose to cheat, not because they were criminals, but because the alternative was losing their job.
They developed euphemisms for it. Inside Wells Fargo, fraud was called gaming. Gaming strategies varied, but the principle was consistent. Create accounts without customer knowledge or consent. Hit your quotas, keep your job.
Some employees would open a checking account for a customer who came in for something simple. Then, while processing paperwork, they'd open a savings account too. The customer wouldn't know. They'd sign documents thinking it was just the one account. The employee would bury the second account in the paperwork, move a small amount of money from checking to savings to fund it, and boom, 2 products instead of 1.
Others went further. They'd open credit cards using existing customer information, create PINs for debit cards customers never requested, enroll people in online banking without permission.
The most brazen? They forged signatures.
Customer didn't want a second account? Didn't matter. Sign their name anyway. Open the account. Move money from their existing account to fund the new one, a practice Wells Fargo insiders called simulated funding. If customers noticed the mysterious accounts and called to complain, employees had a solution. Change the customer's contact information in the system. Give a fake phone number or email address. That way, when the automated customer satisfaction surveys got sent out, they wouldn't reach the real customer. The complaint would never surface.
It was systematic, organized, and management knew.
How do we know they knew? Because internal investigators were raising alarms as early as 2002.
A 2004 internal investigation called the problem a growing plague.
In 2005, another investigator said it was spiraling out of control.
And senior management's response? Keep pushing for higher cross-sell numbers. Keep the quotas, keep the pressure.
Because Wall Street loved the cross-sell story. Investors rewarded it. Stock prices climbed. Bonuses flowed to executives. Why would they kill the golden goose?
Behind every fake account was a real person.
People who discovered mysterious credit cards had appeared in their name. Cards they never applied for, with balances they didn't know existed.
People whose credit scores dropped because of missed payments on accounts they didn't know they had.
People who were charged overdraft fees because money had been moved from their checking account to a secret savings account without permission.
One California teacher discovered 6 fake accounts opened in his name starting in 2006. Wells Fargo even doubled down on 2 of them, opening and closing them back to back in 2016, he later reported. He had no idea until years later.
Another customer found 5 unauthorized accounts. Others found 8, 10, a dozen.
And when they complained, Wells Fargo's response was usually dismissive. Must be a mistake. We'll look into it. Are you sure you didn't sign up for that?
The gaslighting was part of the system. Deny, deflect, make the customer doubt their own memory. Meanwhile, the fraud grew. 2002, 2005, 2008, 2010. Year after year, millions of fake accounts piling up, fees accumulating, credit scores damaged.
And the executives kept bragging about cross-sell ratios to Wall Street.
But some employees refused to play along. And what happened to them shows just how toxic Wells Fargo's culture had become. Yesenia Guitron did everything right.
When she noticed colleagues at her St. Helena branch opening fake accounts, she reported it. Not to gossip sites or the media. She followed proper channels. She went to her manager, then to the ethics hotline, then to the internal training department.
She documented everything, kept records, followed Wells Fargo's own procedures for reporting misconduct.
The ethics hotline was supposed to be safe, anonymous, a way for employees to raise concerns without fear of retaliation. Wells Fargo's official policy said whistleblowers would be protected.
Yesenia Guitron was fired in May 2010.
No warning, no progressive discipline, just gone. The reason given? She didn't meet sales goals.
But Guitron knew the truth. She'd been fired for speaking up, for refusing to commit fraud,
for calling attention to practices that were making her managers look good and hitting corporate quotas.
Unable to find another banking job, she suspected Wells Fargo had blackballed her. Guitron filed a whistleblower complaint with OSHA, Occupational Safety and Health Administration, and eventually a lawsuit.
She wasn't alone. Across the country, Wells Fargo employees who tried to do the right thing discovered that the ethics hotline wasn't a safety valve, it was a trap. Bill Batto worked at a Wells Fargo branch in Pennsylvania. In September 2013, after watching colleagues engage in the same fraudulent practices, he wrote an email to a Wells Fargo HR representative and his regional manager detailing the misconduct. "I have been asked on several occasions to do things that I know are not ethical and would be grounds for discharge," Beto wrote. He described how branch managers asked him to send out debit cards, activate PINs, and enroll customers in online banking, all without the customer's request or knowledge. 8 days later, Bill Batto was fired. The reason? Excessive tardiness. Heather Brock was a senior business banker in Texas. She called the ethics hotline to report the fake accounts she was witnessing. Shortly after, she says she endured harsh bullying, defamation of character, and eventually being pinned for something I didn't do. She was fired in September 2016, just as the scandal was becoming public.
The pattern was consistent and damning. Employees who reported fraud were monitored. Management would watch them, looking for any minor infraction. Late to work once, a misplaced decimal in paperwork, anything, and use it as grounds for termination.
One former Wells Fargo HR official told CNN that the bank had a method in place to retaliate against tipsters. Wells Fargo would find ways to fire employees in retaliation for shining light on sales issues. Ethics complaints were supposed to be confidential, but documents showed that confidentiality was a joke. Managers knew who called, and those employees became targets.
Between 2010 and 2016, dozens of Wells Fargo employees filed whistleblower retaliation complaints with federal authorities. The NBC Bay Area Investigative Unit obtained exclusive data showing the complaints stretched back years, meaning both Wells Fargo and the government knew about widespread problems long before the scandal broke publicly.
Getting fired from Wells Fargo for whistleblowing didn't just cost people their current job, it destroyed their careers.
Wells Fargo maintained what employees called a permanent record, an internal database noting why someone was terminated. If you were marked as fired for cause, other banks wouldn't hire you. The financial industry is small. HR departments talk. A black mark from Wells Fargo meant you were radioactive.
One former personal banker describes his situation to NPR. Fired in 2013 after refusing to open fake accounts and calling the ethics hotline. His house went into foreclosure. He could only find part-time work. Years later, he still couldn't get a banking job.
"They didn't just fire us," one whistleblower said. "They made sure we couldn't work anywhere else."
It was economic warfare designed to send a message. Keep your mouth shut or we'll destroy you.
And it worked. For years, employees who saw the fraud stayed silent because speaking up meant losing everything. By 2012, the problem was impossible to ignore internally. In May 2011, Wells Fargo's Los Angeles regional manager actually said in an internal communication that the bank's senior leadership was not interested in changing the aggressive sales tactics. Regional managers passed down quotas from corporate. Branch managers passed them to personal bankers and tellers. Everyone knew the numbers were unrealistic. Everyone knew people were gaming to hit them. And everyone understood the unspoken rule: don't ask how the sausage is made. In 2013, Wells Fargo's board of directors was briefed on the sales practices problems. According to an internal investigation report released years later, board members knew that employees were opening unauthorized accounts as far back as 2002.
Let that sink in. The board knew for over a decade, and the fraud continued.
Why? Because it was profitable.
Between 2011 and 2015, Wells Fargo opened approximately 1.5 million deposit accounts and 565,000 credit card accounts without customer authorization. Each account generated fees, overdraft fees, monthly service fees, credit card annual fees, late payment fees.
The bank was literally robbing its own customers, one $35 overdraft fee at a time. And all the while, executives were getting rich.
But by 2015, the walls were starting to crack, and outside authorities were finally paying attention.
Mike Fewer was Los Angeles City Attorney. His office handled consumer protection cases. In 2013, his team started receiving complaints from Wells Fargo customers, people claiming the bank had opened accounts without permission.
At first, it seemed like isolated incidents. A few customers, maybe rogue employees at a couple branches. But as Foyer's investigators dug deeper, the pattern became impossible to ignore. This wasn't a few bad apples. This was systematic fraud across hundreds of branches.
Fire's office launched an investigation. They subpoenaed documents, interviewed employees, built a case. What they found was staggering.
Wells Fargo's Los Angeles Times also began investigating independently in 2013. Reporter E. Scott Reckard published articles detailing the pressure cooker sales environment and the fake accounts problem.
But Wells Fargo had mastered the art of damage control. The stories got limited attention. The bank issued carefully worded statements acknowledging isolated incidents and claiming they were addressing the issues. Internally, nothing changed. The quotas continued, the gaming continued, the retaliation against whistleblowers continued. But on September 8, 2016, things came to a halt.
On that Thursday morning, the Consumer Financial Protection Bureau, CFPB, the federal agency created after the 2008 financial crisis to protect consumers from predatory financial practices, announced a $185 million fine against Wells Fargo.
The CFPB, along with the Office of the Comptroller of the Currency, OCC, and the Los Angeles City Attorney's Office had coordinated their enforcement actions. The public learned for the first time the scope of the fraud. 1.5 million unauthorized deposit accounts and 565,000 unauthorized credit card accounts opened between 2011 and 2015 alone.
Wells Fargo admitted it had fired 5,300 employees for their involvement in creating fake accounts.
5,300 people, low-level workers, personal bankers making $12 to $15 an hour, tellers, customer service reps.
Not one executive, not one senior manager, not one board member.
The message was clear. The grunts took the fall.
But the American public wasn't buying it.
The story exploded across media. Cable news ran it for days. Newspapers devoted front pages to it. Social media erupted. The optics were devastating. A bank that had survived the 2008 financial crisis with its reputation relatively intact, that had marketed itself as community-focused and customer-friendly, had been systematically defrauding millions of people.
And they blamed the fraud on employees they'd been pressuring to commit it.
Senator Elizabeth Warren led the charge. On September 20, 2016, Wells Fargo CEO John Stumpf was summoned to testify before the Senate Banking Committee.
It did not go well.
Stumpf, 63, had been CEO since 2007 and chairman since 2010. He'd overseen Wells Fargo during its rise to become America's most valuable bank. He made $19.3 million in 2015 alone.
He sat at the witness table, delivered prepared testimony, and then faced the senators.
Senator Warren went for the throat. You haven't resigned. You haven't returned a single nickel of your personal earnings. You haven't fired a single senior executive, Warren said, her voice sharp with contempt. Instead, evidently, your definition of accountable is to push the blame to your low-level employees who don't have the money for a fancy PR firm to defend themselves. This is about accountability. You should resign. You should give back the money you took while this scam was going on, and you should be criminally investigated by both the Department of Justice and the Securities and Exchange Commission.
The clip went viral. Millions watched Warren dismantle Stumpf on live television.
Senator Bob Corker of Tennessee piled on, saying Stumpf would be engaging in malpractice if Wells Fargo didn't claw back money the bank had paid executives during the period when fake accounts were being opened.
Stumpf tried to defend the bank's actions. He claimed he was deeply sorry. He said Wells Fargo had eliminated sales goals and was making things right with customers.
But he wouldn't commit to returning his own compensation. He wouldn't say any executive should be fired. He deflected, dodged, and stuck to talking points.
America watched a multimillionaire CEO squirm while trying to avoid taking responsibility for a fraud that happened on his watch. Within months, the scope of the scandal grew worse.
In May 2017, Wells Fargo revised its estimate. The number of fake accounts wasn't 2.1 million, it was closer to 3.5 million.
And the timeline was longer than initially disclosed. Internal documents showed the fraud dated back to at least 2002, not just 2011.
That meant the fake account scandal had been running for 14 years.
14 years of forging signatures, 14 years of unauthorized credit cards, 14 years of stolen fees, 14 years of damaged credit scores, 14 years of executives knowing and doing nothing.
The Department of Justice opened a criminal investigation. The SEC launched its own inquiry. Class action lawsuits piled up. State attorneys general from across the country announced investigations.
Wells Fargo's stock price plummeted. The bank's market value dropped by billions. The reputational damage was catastrophic.
And then the secondary scandals started emerging.
In December 2016, whistleblowers from Prudential Financial revealed that Wells Fargo had also been selling customers unwanted life insurance policies without their consent. In July 2017, Wells Fargo admitted it had charged approximately 570,000 auto loan customers for car insurance they didn't need. Some of these customers had their cars repossessed for failing to make payments they couldn't afford because Wells Fargo had secretly added insurance costs to their bills. About 20,000 customers lost their vehicles because of this fraud. In April 2017, the bank acknowledged it had charged thousands of mortgage customers unfair fees for missing rate lock deadlines. Except the delays were caused by Wells Fargo's own processing failures, not customer error. Each new revelation hammered the bank's credibility further into the ground.
This wasn't a one-time fraud. This was a culture of deception, a business model built on taking advantage of customers who trusted them.
John Stumpf didn't last a month after his Senate testimony.
On October 12, 2016, 31 days after Elizabeth Warren had eviscerated him on national television, Stumpf announced his immediate retirement as CEO and chairman of Wells Fargo.
He walked away with millions. His retirement package, stock options, and deferred compensation meant he was leaving with enormous wealth intact, though the board did eventually claw back $41 million from him.
Still not enough, critics said. Stumpf had made hundreds of millions during his tenure. 41 million was a rounding error.
He was replaced by Tim Sloan, a Wells Fargo lifer who'd been with the bank for 29 years. Sloan promised change. He said the toxic sales culture was being dismantled. He claimed employees now felt safe reporting misconduct. But multiple employees told the New York Times that high-pressure sales goals still plagued the bank. The culture hadn't changed. They'd just gotten better at hiding it. In March 2019, less than 3 years after taking over, Sloan resigned under pressure. Representative Maxine Waters had called for his ouster, tweeting that Sloan enabled Wells Fargo's massive fake account scam and profited from it. The revolving door at the top kept spinning.
Carrie Tolsted's reckoning.
But the executive the public really wanted to see punished was Carrie Tolsted.
Tolsted had run Wells Fargo's community bank, the division responsible for retail banking, where all the fraud occurred. She'd been in that role since 2007.
She was the one who had overseen the impossible sales quotas. She was the one who'd pushed the 8 is great mantra. She was the one who'd minimized the fraud to senior leadership and the board. And she'd gotten rich doing it. Tolsted retired in July 2016, before the scandal broke publicly, with a $125 million exit package.
The timing was suspicious. Did she know the scandal was about to blow up? Had she gotten out while she could?
After the scandal broke, Wells Fargo's board clawed back $47.3 million of Tolsted's compensation. She was also banned from the banking industry for life by federal regulators.
But it wasn't enough. Prosecutors wanted more.
In March 2023, Carrie Tolsted pleaded guilty to one count of obstructing a bank examination. She admitted that between 2013 and 2016, she'd knowingly misled bank regulators about the extent of the fake accounts problem.
She faced up to 5 years in prison.
In September of 2024, Carrie was sentenced to 3 years of probation, no prison time, and 3 months of home detention. She also agreed to a lifetime ban from banking, plus a $17 million fine.
No prison time for someone who orchestrated a fraud that affected millions of people. The outrage was immediate. How did an executive who oversaw systematic fraud for years, who destroyed evidence, who misled regulators, avoid prison?
The answer, critics said, was the same as always. Different rules for rich people.
In January 2025, the OCC, Office of the Comptroller of the Currency, announced final penalties against 3 more Wells Fargo executives.
Claudia Russ Anderson, the bank's former community bank group risk officer, was fined $10 million and banned from banking for life. Between 2013 and 2016, she'd failed to challenge the incentive program that incurred fraud, failed to institute effective controls, and provided false information to regulators. David Julian, a former chief auditor, received a $5 million fine and a prohibition order. He'd failed to ensure Wells Fargo's internal audit function provided independent oversight of sales practices.
Paul McClinko, another executive audit director, got a $1.5 million fine for similar failures.
Combined with earlier penalties, the OCC had fined 11 Wells Fargo executives a total of more than $43.1 million.
But still, no one went to prison, except in the case of Tolsted, who avoided it entirely.
The pattern was clear: financial penalties, bans from the industry, clawbacks, but not criminal prosecution for fraud that destroyed lives.
In February 2020, Wells Fargo reached a settlement with the Department of Justice and the SEC for $3 billion to resolve criminal and civil investigations into the fake account scandal.
It was one of the largest penalties ever imposed on a bank for consumer fraud.
As part of the settlement, Wells Fargo entered into a deferred prosecution agreement. The bank admitted to pressuring employees between 2002 and 2016 to meet unrealistic sales goals, which led thousands of employees to provide millions of accounts or products to customers under false pretenses or without consent, often by creating false records or misusing customers' identities.
The settlement included acknowledgement that
Top managers knew about the fraud as early as 2002.
Senior leadership minimized the problems to Wells Fargo's board.
The bank had failed to take sufficient action to prevent or reduce the fraud.
community bank leadership refused to alter the sales model despite knowing it contained unrealistic goals. $3 billion sounds like a lot, but Wells Fargo's annual revenue was over $80 billion. The fine was barely a month's worth of income.
And $3 billion doesn't bring back repossessed cars, doesn't fix destroyed credit scores, doesn't compensate people who lost jobs or homes because of fraudulent fees.
The victim's compensation.
Wells Fargo set up a remediation program to compensate victims. By 2024, the bank claimed it had refunded approximately $600 million to affected customers. But determining who was harmed and by how much proved complicated. Many victims didn't even know they'd been defrauded. The bank had hidden accounts so well that customers only discovered them years later, sometimes by accident. A class action lawsuit resulted in a $142 million settlement for affected customers in 2017. Another lawsuit settled for $480 million in 2018 over securities fraud, investors who'd bought Wells Fargo stock based on inflated cross-sell metrics. But individual victims often received paltry amounts. One customer who'd had 6 fake accounts opened in their name dating back to 2006 was offered less than $500 in compensation. "I deserve a hell of a lot more," they wrote online.
They want me to sign a form saying I won't do any litigation against the company. Looking for a good lawyer to handle this. The settlements included arbitration clauses that prevented many victims from suing. Wells Fargo had weaponized fine print in customer agreements to shield itself from accountability.
And while executives faced penalties and victims waited for compensation, the rank-and-file employees who'd been pressured into fraud in the first place were left to pick up the pieces. When Wells Fargo announced it had fired 5,300 employees for creating fake accounts, the media initially framed it as the bank taking action against wrongdoers.
But as former employees began speaking out, a different story emerged.
These weren't master criminals. They were ordinary people, often young, making $12 to $15 an hour, working their first professional job. They'd been caught between impossible quotas and the threat of termination.
Some had committed fraud, others had been fired and been fired anyway. All of them had been chewed up by a system designed to extract maximum profit, regardless of the human cost.
The ones who committed fraud.
Many fired employees described the impossible situation they'd faced. Daily quotas. Open 8 new accounts. Sell 5 credit cards. Sign up 12 people for online banking. Every day, regardless of foot traffic, regardless of whether customers wanted or needed these products. Miss your numbers consistently, you'd be put on a performance improvement plan. Corporate speak for, we're building a paper trail to fire you. Branch managers would hold daily huddles where they'd announce everyone's numbers from the previous day. Public shaming if you were low, recognition if you were high. Some branches had leaderboards, your name in green if you hit targets, red if you didn't. Everyone could see who was failing.
The pressure was relentless. Phone calls from regional managers, visits from district managers. Your job and your ability to pay rent, feed your kids, keep your car, depended on numbers that often required fraud to hit.
So people cheated, not because they were bad people, because they were scared.
One former employee described opening accounts for family members, using his parents' information, his siblings, anyone he could access. He'd open the accounts, fund them with minimum balances, then close them weeks later. Hit the quota, keep the job. Apologize to family later. Others would open accounts for customers who came in for one thing, hiding the extra accounts and paperwork. Move $25 from checking to a new savings account. Customer probably wouldn't notice. Hit the quota. The most desperate would fabricate entirely. Forge signatures. Create accounts using customer information from the database. Move money around. Hope nobody noticed. I hated it, one former personal banker told NPR. Every day I felt sick to my stomach. But I had student loans, I had rent. If I got fired, how would I find another job? I told myself it was temporary, that I'd get out soon. They got fired anyway. When the scandal broke, Wells Fargo purged thousands of employees, the ones who'd been forced to commit fraud to keep their jobs in the first place.
The ones who refused.
Then there were employees like Yesenia Guitron, Bill Batto, and Heather Brock, people who'd refused to play along and paid the price. One former banker in Oregon described watching her manager openly coaching employees on how to open fake accounts without getting caught. When she refused and called the ethics line, she was fired 2 weeks later for not being a team player. She couldn't get another banking job for 3 years. Her unemployment claim was denied because Wells Fargo said she'd been fired for cause. She lost her apartment, moved in with her parents at age 32, watched her credit score tank because she couldn't pay her bills. I did the right thing, and it ruined my life, she said. Meanwhile, the people who taught us how to commit fraud got promoted. Another former employee described the culture of fear. You either committed fraud and got fired when they needed scapegoats, or you refused and got fired for not meeting quotas. Either way, you lost.
The ethics hotline, supposedly a safe way to report problems, was a joke. Multiple former employees described calling it and being fired within weeks. The confidentiality was meaningless. Managers knew who called.
One former employee filed a complaint with OSHA in 2010. The case dragged on for years.
In 2022, OSHA finally ordered Wells Fargo to pay the employee $22 million for retaliation.
But that employee's career had been destroyed 12 years earlier. The $22 million didn't undo a decade of financial struggle.
Perhaps the cruelest aspect, Wells Fargo marked terminated employees as not eligible for rehire and flagged them in internal systems.
When these former employees tried to get banking jobs elsewhere, Wells Fargo's reputation followed them. Background checks revealed they'd been fired from Wells Fargo. HR departments at other banks wouldn't touch them.
It didn't matter if they'd been fired for refusing to commit fraud. Fired was fired.
Some former employees went years unemployed in their field. They'd gotten finance degrees, built skills, and then been shut out of the industry entirely.
One former personal banker ended up working retail at Target. Another became an Uber driver. A third went back to community college to train for a different career entirely.
Their lives had been derailed. Meanwhile, Carrie Tolstead retired with $125 million. In April 2017, after immense public pressure, Wells Fargo announced it would rehire approximately 1,000 employees who had either been wrongfully terminated or who had quit in protest of fraud.
It was a PR move, an acknowledgement that the bank had destroyed innocent people's careers.
But by then, many of those employees had moved on, found other work, left the banking industry entirely. Some wanted nothing to do with Wells Fargo ever again.
And the offer came with conditions. Sign agreements limiting your ability to sue. Accept the company's determination of what salary and back pay you're owed. Come back to a bank that had betrayed you once already.
Many declined. The wounds were too deep. The trust was gone.
The lasting damage.
By 2018, Wells Fargo had paid billions in fines and settlements. Executives had been penalized. The bank claimed to have reformed its culture.
But the human cost couldn't be calculated in dollars.
Thousands of low-level employees lost careers. Millions of customers had credit damaged. Families lost cars to repossession. People's trust in banking, already shaken by the 2008 crisis, eroded further. And the message sent to corporate America: crime pays if you are at the top. The grunts take the fall. Executives get clawed back but stay rich. Nobody goes to prison for corporate fraud. But the scandal's impact reached far beyond Wells Fargo. It changed how America views its banks and raised questions that still haven't been answered.
But the scandal's impact reached far beyond Wells Fargo. It changed how America views its banks and raised questions that still haven't been answered.
8 years after the scandal broke, Wells Fargo is still paying for it. The bank has paid over $5 billion in fines, settlements, and customer remediation. It faces ongoing regulatory restrictions. The Federal Reserve has capped Wells Fargo's asset growth until the bank proves it's fixed its compliance and risk management problems, an unprecedented restriction still in effect.
The Stagecoach commercials are gone. The "Together We'll Go Far" slogan rings hollow. Customer trust surveys consistently rank Wells Fargo among the least trusted major banks.
And yet, Wells Fargo survives. It's still the 4th largest bank in America. It still makes billions in annual profit. The stock price has recovered most of its post-scandal losses.
Corporate crime is remarkably survivable if you're big enough.
Wells Fargo insists the culture has changed. Sales quotas are gone. The cross-sell ratio is no longer reported to investors. Employee surveys supposedly show improved working conditions.
But former employees who've left recently tell a different story. The pressure is still there, they say, just better disguised. Instead of explicit quotas, there are goals and expectations. Instead of public leaderboards, there's private performance monitoring.
They learned to hide it better, one employee who left in 2022 told a journalist. But the culture of fear is still there. You still feel like you need to hit numbers or you're out.
Wells Fargo disputes this. The bank points to investments in compliance, ethics training, and whistleblower protections as evidence of change.
But trust, once broken, is hard to rebuild. And Wells Fargo broke trust with millions.
How did this happen for 14 years without regulators stopping it?
The Office of the Comptroller of the Currency examines Wells Fargo regularly. They have examiners on site.
They review internal audit reports. They're supposed to catch this stuff. And they did, sort of. Internal Wells Fargo documents show that OCC examiners raised concerns about sales practices as early as 2010. They sent letters, they asked for action plans, they documented problems.
But they didn't shut it down. They didn't fine the bank. They didn't force systemic changes. They let it continue.
Why? Critics point to regulatory capture, the phenomenon where regulators become too cozy with the industries they're supposed to police. Bank examiners want to avoid being seen as hostile to banks. They want cooperation. They accept promises to do better.
Until a crisis forces action, regulators often punt problems down the road.
The CFPB, which finally brought the hammer down in 2016, wasn't even created until 2010, after the 2008 financial crisis. If not for that agency, it's possible defraud would have continued even longer.
The lesson: regulatory oversight is only as strong as regulators' willingness to act, and too often they don't act until the media forces them to.
The criminal justice question.
Why didn't anyone go to prison?
This is the question that haunts the whole scandal. Millions of fake accounts, billions in fraudulent fees, 14 years of systematic fraud, and the worst punishment for any executive, 3 years of probation and home detention.
The Department of Justice's settlement with Wells Fargo was a deferred prosecution agreement. The bank admitted wrongdoing but wasn't charged criminally. And individuals at the bank? The DOJ focused on civil penalties, not criminal prosecution.
Why? Proving criminal fraud requires showing intent. You need evidence that specific individuals knew they were committing crimes and did so deliberately. In a large corporation, responsibilities are diffused. Executives can claim they delegated oversight. They didn't know details. They relied on compliance departments.
It's the same problem that plagued prosecutions after the 2008 financial crisis. Complex corporate structures make accountability hard. Prosecutors want slam dunk cases. Juries are skeptical of white-collar crime. Defendants have expensive lawyers.
So prosecutors settle. Banks pay fines. Executives get clawed back. Nobody goes to prison. The message this sends is corrosive. Steal a car, go to jail. Steal from millions of customers, pay a fine, and retire rich. Many victims of Wells Fargo's fraud still haven't been fully compensated.
The remediation process was complex and often inadequate. Customers had to prove they'd been harmed. They had to document fees charged on accounts they didn't know existed. They had to show credit score damage and connect it to Wells Fargo's actions.
Many gave up. The process was too complicated. The compensation offered too small. Some accepted paltry settlements because fighting Wells Fargo's lawyers seemed impossible. Others are still fighting. Class action lawsuits continue. Individual claims drag through arbitration. The cleanup isn't finished.
And some damage can't be compensated. The person who lost their car to repossession and then lost their job because they couldn't get to work? What's the dollar value of that downward spiral? The teacher whose credit score dropped 150 points because of a fake credit card, preventing them from refinancing their mortgage? How do you calculate that loss?
Money helps, but it doesn't make victims whole.
After 2008's financial crisis, Americans already distrusted big banks. The Wells Fargo scandal poured gasoline on that fire. A 2017 Gallup poll found that only 27% of Americans had confidence in banks, the lowest level since Gallup began tracking the measure in 1979. Wells Fargo's scandal was cited as a major reason. When even your local bank, the friendly branch where you know the tellers' names, turns out to be systematically robbing customers, who can you trust? This erosion of trust has consequences. People avoid banks. They use alternative financial services, check cashing stores, payday lenders that are often more expensive and predatory than traditional banks. Ironically, Wells Fargo's fraud pushed vulnerable people toward even worse financial actors. And the distrust isn't just about banks, it's about institutions generally, about whether rules apply equally, about whether the system is rigged for the wealthy and powerful.
Wells Fargo confirmed what many Americans already suspected.
The game is rigged. The rich get richer. The rules don't apply to them, and ordinary people pay the price.
In 2024, Wells Fargo still exists, still operates, still makes money.
Tim Sloan is gone. Carrie Tolstead is banned from banking. John Stumpf is retired. New leadership claims new culture.
But the fundamental questions remain.
Did Wells Fargo truly change, or did it just get better at hiding problems?
Did the regulatory system learn lessons? Or will the next scandal catch them equally flat-footed?
Did justice get served, or did wealthy executives skate while low-level employees took the fall?
The answers are complicated and unsatisfying.
Because here's the truth. Corporate fraud is hard to prevent, hard to detect, and hard to punish, especially when it's distributed across thousands of employees, embedded in corporate culture, and enabled by leadership that looks the other way. Wells Fargo committed one of the most brazen consumer frauds in American banking history, and they mostly got away with it. The fines hurt, the reputation damage stung. Executives faced consequences.
But the bank survived. The shareholders recovered, new executives moved into corner offices.
And somewhere in America right now, in some corporate office, someone is facing an impossible quota. A sales target they can't hit without cutting corners. A choice between ethics and keeping their job.
What will they choose?
Wells Fargo showed us that when corporate culture demands impossible results, ordinary people will do extraordinary things to survive. Some will cheat, some will quit, some will speak up and suffer for it.
And the system? The system will look the other way until the scandal gets too big to ignore.
Then it'll find the company, blame low-level employees, and move on.
Until the next time.
Wells Fargo didn't just defraud millions of customers. It didn't just destroy thousands of employees' careers. It didn't just enrich executives who should have known better.
It broke something more fundamental. The basic faith that financial institutions will protect, not exploit, the people who depend on them.
And that's a type of damage no fine, no settlement, no remediation program can fully repair.
The stagecoach still rolls through Wells Fargo's branding, but the trust, that's not coming back.
Not after the bank that promised to help you go far turned out to be picking your pocket the whole time.
Go ahead and like, subscribe, and share this story to support this channel.